All right, welcome back to Pietros Maneos Finance. This video is a follow-up to a video I did a few days ago on Howard Marks's book. Just finished it actually tonight. The title is The Most Important Thing, Uncommon Sense for the Thoughtful Investor. And I was pretty critical in the first video as I came across two particular passages, literally on the first two pages, that I felt to just be blatantly wrong. But as I got through the book, I really enjoyed it. And I think it's worthwhile for all investors or would-be investors or people that are trying to increase their investing IQ. He's definitely an important figure in modern investing. He comes highly recommended by Buffett, which is actually why I picked this book up. And I can see why he comes highly recommended by Buffett. There's almost a mutual admiration society. He references Buffett often, and he actually does these memos that are redolent of Warren Buffett's Berkshire Hathaway annual letters, annual reports. So you can very much see Buffett's influence on Howard Marks. Another thing that I noted was he often references Taleb, Nassim Nicholas Taleb. So he references Buffett a lot. He references Taleb a lot. Of course, Benjamin Graham as well. So it was definitely an enlightening, illuminating book, and I recommend it. What I wanted to do is just to read a couple passages. The last time I read the passages that I felt were wrong, and just to refresh for those of you who didn't see that video, he criticized indexing as settling for average returns instead of settling for above average returns. There you can just look at Jack Bogle, J.L. Collins, look at the data, that the whole statement, you're settling for average by buying the index, is just not the case, because you're going to outperform, depending on the time period, 70, 80, 90% of active management. And the second thing is that you can't defer investing to a computer or an algorithm. And I kind of just basically said, has he not heard of Renaissance Technologies and Jim Simmons? So those are my two critiques on the first two pages. But let me read now things that I very much enjoyed. So on page 17 here, he's talking about day traders, and I just thought it was an interesting way he described it. It seems clear that momentum investing isn't a cerebral approach to investing. The greatest example came in 1998 and 1999 with the rise of people called day traders. Most were non-professional investors drawn from other walks of life by the hope for easy money in the tech, media, telecom stock boom. They rarely held positions overnight, since doing so would require them to pay for them. Several times a day, they would try to guess whether a stock they'd been watching would rise or fall in the next few hours. I've never understood how people reach conclusions like these. I liken it to try to guess whether the next person to come around the corner will be male or female. The way I see it, day traders considered themselves successful if they bought a stock at 10 and sold it at 11, bought it back the next week at 24 and sold at 25, and bought it a week later at 39 and sold at 40. If you can't see the flaw in this, that the trader made $3 in a stock that appreciated by 30, you probably shouldn't read the rest of this book. I just thought that was a beautiful passage there. And yeah, it's just sort of that idea of, you're making pennies when you could be making dollars, essentially. You're trading in and out, but if you just bought the stock initially and held it, your gain is much more than trying to close your position at the end of the day and guess which direction is going to go the next 10 seconds or so. So I thought that was a great passage there. The next one is on page 28 and is on bubbles. So here it is. It's essential to understand that fundamental value will be only one of the factors determining a security's price on the day you buy it. Try to have psychology and technicals on your side as well. The polar opposite of conscientious value investing is mindlessly chasing bubbles, in which the relationship between price and value is totally ignored. All bubbles start with some nugget of truth. I like that line. All bubbles start with some nugget of truth. And he gives three examples here. Tulips are beautiful and rare in 17th century Holland. Second one. The internet is going to change the world. Third one. Real estate can keep up with inflation, and you can always live in a house. A few clever investors figure out, or perhaps even foresee these truths, invest in the asset, and begin to show profits. Then others catch on to the idea or just notice that people are making money and they buy as well, lifting the asset's price. But as the price rises further and investors become more inflamed by the possibility of easy money, they think less and less about whether the price is fair. It's an extreme rendition of the phenomenon I described earlier. People should like something less when its price rises. But in investing, they often like it more. Just a quick little aside, we're kind of dealing with that in the single family housing market now in 2021. Just my own example, the home I'm sitting in, I purchased it last year, September of 2020 for $730,000. It's now probably worth 1.1 million, 1.3 million. So it's almost doubled within a year. The only major addition I've done to it is paint, and it's doubled in value. So that's interesting. I'm not going to sell it because I love living here. I have my garden, as you'll see in the subsequent videos in the next few months, with my Cherokee purples and my Cherokee purple tomatoes and my Jimmy Nardello peppers. So even if you gave me a bigger house without a garden, I wouldn't be happier. So anyway, so let's go on to the third. But yeah, I just like that line again. In all bubbles, there's a nugget of truth that starts it. And then this is a passage I very much enjoyed, and it's because I always say this. A lot of people know that I invest, and so they'll ask me, "Oh, well, what do you think the market's going to do?" And you think the market is overvalued and undervalued, or you think it's the interest rates are going to rise, and then this is going to happen. And I've never really had an interest in kind of global macro market calls. And I've always felt that the money's really in the micro, not in the macro. And again, I'm sure there are successful global macro investors. It's just not something that I've ever been attracted to. I've been much more attracted to the Benjamin Graham, the intrinsic value of something, value investing overall, fundamental investing, dividend investing, as opposed to making market calls. And so when I turn on like Bloomberg or CNBC, you'll just see people just like throw out predictions all the time. Yeah, it's just not for me. But anyways, so let's go here. It's right on page 120. Yeah. So he's in agreement with me here. He said, "It's no secret that I have a limited opinion of forecasters and those who resolutely believe in them. In fact, I've come up with a label for these people. Most of the investors I've met over the years have belonged to the, quote, I know, end quote, school. It's easy to identify them. They think knowledge of the future, direction of economies, interest rates, markets, and widely followed mainstream stocks is essential for investment success. They're confident it can be achieved. They know they can do it. They're aware that lots of other people are trying to do it too, but they figure either A, everyone can be successful at the time, or B, only a few could be, but that they're among them. They're comfortable investing based on their opinions regarding the future. They're also glad to share their views with others. Even correct forecasts should be of such great value that no one would give them away gratis. They rarely look back to rigorously assess their record as forecasters." I'll go on, but I can't let it slide here. When I read this, I think of Nouriel Roubini. He's been wrong so many times, and yet Roubini gets, because he's negative and angry. So he makes good TV. He gets brought on all the cable news shows, and so that last line, they rarely look back to rigorously assess their record as forecasters. And I just think of Roubini right there. Sorry. Um, Anyways, confident is the key word for describing members of the school. I would also say those who are negative oftentimes get more attention as well. Being angry and negative, you're going to just get that little soundbite on cable news. But anyways, confident is the key word for describing members of the school. For the I don't know school, on the other hand, the word, especially when dealing with the macro future, is guarded. Its adherents generally believe you can't know the future. You don't have to know the future. And the proper goal is to do the best possible job of investing in the absence of that knowledge. As a member of the I know school, you get to opine on the future and maybe have people take notes. You may be sought out for your opinions and considered a desirable dinner guest, especially when the stock market's going up. Join the I don't know school, and the results are more mixed. You'll soon tire of saying, I don't know, to friends and strangers alike. After a while, even relatives will stop asking you where you think the market's going. You'll never get to enjoy the 1 in 1,000 moment when your forecast comes true and the Wall Street Journal runs your picture. On the other hand, you'll be spared all those times when forecasts miss the mark, as well as the losses that can result from investing based on overrated knowledge of the future. So, and I'll share one more passage that I really enjoyed. And I think this passage is one, it's a shame I didn't have my YouTube channel set up during the panic of 2020, because it would have been fascinating, I feel, to see my account going down by hundreds of thousands of dollars. And yet, instead of panic selling, I'm buying all the cruise lines. I'm buying the airlines, even against one of my heroes, Buffett, who sold. I'm buying hotels. I'm buying energy. And now that $200,000 account is a $650,000 account. It's gone up 3 times since then. So, but it would have just been fascinating to see it on the way down, and see how emotionally strong I was at the time, or not, because you can see people that just capitulate at a certain point. And this would be a great passage to read in the next panic, whether it's 2022, 2023, 2027, 2030, whenever that happens. This would be something to keep in your back pocket. The power of psychological influences must never be underestimated. Greed, fear, suspension of disbelief, conformism, envy, ego, and capitulation are all part of human nature. And their ability to compel action is profound, especially when they're at extremes and shared by the herd. They'll influence others, and the thoughtful investor will feel them as well. None of us should expect to be immune and insulated from them. Although we will feel them, we must not succumb. Rather, we must recognize them for what they are and stand against them. Reason must overcome emotion. Beautiful passage by Mr. Howard Marks there. And I would print this out, put this in your back pocket. And when the market from 35,000 goes to 38,000, and then we go from, let's say, 38,000 down to, and I'm not a global macro guy here predicting it. I'm just saying when that happens, I have no idea when it will happen. I have no idea how brutal it will be. But when we go from 35 or 38,000 to 30,000 to 25,000 to 20,000, this would be a great passage to read. I actually posted on my Seeking Alpha essay at the time, Rudyard Kipling's If, read by the actor Michael Caine. And I think that's a beautiful poem to read when you're hemorrhaging hundreds of thousands, if not millions of dollars in market crashes. So anyway, so that's so that's Howard Marks. Here it is. I'll put the link to this book um, in the description area, and I definitely highly recommend it. I actually just ordered his other book now, just a few minutes ago. I believe it's Mastering the Market Cycle or Mastering Market Cycles. So very excited to read that as well. So, anyways, that's it for this evening. The market's open tomorrow. Holiday's over. Anyways, take care, guys. Ciao.